Hey guys, what's up? Welcome to the Dude Real Estate Show. Once again, I am here with Billy. Billy, how's it going?
I'm good. I'm excited for today.
Good. Me too. You don't know what the topic is today. I'll announce that in a second. But first, you said you had a question. So hopefully, I have an answer.
Yeah. I'm looking at a property right now, and it has a lot of things that I like from the numbers standpoint, but it's a little bit outside of my financial reach to put 25% down as the down payment on the property and do a traditional loan through a bank. Um, So I have reached out to a family member to see if they would uh, partner or invest with me and ultimately fund that down payment for me, help fund the down payment for me. And so I've talked with a couple banks, and I'm curious: is it is the gift is it being a gift to me? Does it need a season in my account? I guess that probably depends on the bank. And if so, I guess how long does it need a season?
Right. Okay. So I am not a mortgage expert, but I have had some experience with some of this stuff. I've seen a few loans in my days. I was just signing some loan docs this morning, actually. So yeah, it depends on the bank.
Hmm.
And it depends on the amount of the gift and all sorts of stuff. So I guess my best answer is, shop around, but it sounds like you're doing that. My
Hmm.
experience has been that sometimes a bank needs, obviously there has to be documentation of the gift.
Yeah.
And then, yet they usually do want some sort of seasoning period. Sometimes it's a month, sometimes it's 2 months.
Hmm.
But there have been occasions too where I believe, and maybe this was different, it might have been a hard money loan or something like that, where it wasn't really a gift, but an investor, and some hard money lenders were okay with basically funds hitting my account, the day before, but
Hmm.
others were like, well, we'd rather have it there for a while.
Yeah.
So yeah, I think banks like to see that there's something there, which is called that seasoning period. It kind of needs to sit and simmer for a little bit. I probably so they can go make loans on the money.
Yeah. Use it.
Yeah, so they can use it first. Um, and but I wouldn't necessarily take no as the final answer. I would maybe just do a little more digging, talk to a few more brokers or banks,
Yeah.
maybe try to find some info online or on Bigger Pockets to see what other people are experiencing with a gift. Obviously, you could reach out to our networking group, a lot of
Hmm.
really knowledgeable people on there on the Slack channel. So you could reach out there and see if other people have had, I mean, it's a fairly common thing because people get gifted portions or entire down payments all the time from family or friends. So it happens quite a bit, but the bank rules and mortgage rules change constantly.
Hmm.
And each bank is different too. So they have different
Right.
policies, and everyone's going to abide by their, by federal guidelines and stuff, but then each bank is going to have their own kind of
Sure.
code. Um, I suppose you could think of it in a different way though. I mean, um, maybe there's another way to get money without having it show up as a gift.
Okay.
If you can kind of funnel some money around differently and have the gift appear later or something like that.
Yeah.
If you could just get like a loan from a buddy,
Right.
but then they still might look at it as like a seasoning thing. Oh, where'd that 5 grand come from? You know?
Exactly.
So yeah, again, it just kind of, at the end of the day, I don't know why it matters so much to the banks. Um, if the money's there, the money's there. Obviously, they're concerned about underwriting everything, but a lot of that comes down to your debt to income ratio, your credit worthiness, that kind of stuff. I guess they just want to make sure nothing illegal is going on or like money laundering, perhaps stuff like that. So,
Sure.
they're just covering themselves there. So,
Sure.
That's my rambling non-answer, I guess.
No, I get you. I get what you're saying. How does, going off of that, being that it's quote unquote a gift in the bank's mind, how would you, and I'm doing the loan in my, personal name, how do you structure that with, a family friend, or what's the, because we're not putting together an LLC, because if we did that, the bank that I talked with said it would have to be a 15-year loan, which makes it so it doesn't really make sense as an investment, but it makes sense when it's a 30-year loan. Um, how do you, I guess that's something you just talk about with the person you want to bring in, or?
Well, I mean, if it's technically a gift,
Yeah.
then there's no repayment, right? So if it's a loan, though, that's a different story.
Mm-hmm.
If you're giving them, 7% interest on
Yeah.
$10,000 over the course of 2 years, then you can just have a simple agreement between the two of you, have it written down and just kind of work it that way, whether it's monthly payments or lump sum or whatever it is. Again, I don't know what the bank would say to something like that. They're still going to want to know why or where the money is coming from, and then that seasoning question: how long does it need to be there?
Yeah. Okay.
Yeah. So I know it gets kind of tricky with that stuff. But if it's a screaming deal, you're probably, I mean, it sounds like it's a good enough deal where you are trying to think of some other creative scenarios to help you get it, which I think speaks to probably the nature of the deal, because I know you're pretty analytical and you know your numbers really well. So it must be something worth doing. Otherwise you wouldn't be exploring that kind of stuff.
Yeah, I think so. And it goes back to what you said earlier on our group here or video. The second deal doesn't come if you don't do the first deal.
That's correct. 100% of the time.
100% of the time. I butchered it, but
no,
what I'm saying.
I know what you're saying, and you know what you're saying. Cool. Well, today we're going to tackle something that we've kind of dabbled in a couple times, but we're going to go a little more in depth about investing long distance. Mm-hmm. And I know this is really scary for a lot of people, but I think I mentioned in the last video, or maybe the one before that if you're willing to go an hour or two away from home, essentially, to buy and manage a property, why not go 1,000 miles? So I'll just go over some of the pros and cons. Some of the pros would be you can really pick any market. I mean, there's thousands of markets across the country, and you can pick one that is geared right toward your goals. So if you want like massive cash flow, you're probably going to go try to find some of those 2% properties, properties that just have amazing cash flow. Sometimes you can find them for really cheap too, which tends to happen with some of those 2% deals. It might be a $60,000 property that rents for $1,200 a month. And of course, a lot of people are looking for those. So maybe there's a little bit of competition there. But the nice thing about just going anywhere, it just opens you up to so many things. You can look at just the broader demographics. You can see where people are moving to, where people are moving out of. Mm-hmm. You can kind of pick your price points then too. So if it's like, well, I really want to invest in just small multifamily with a price point of, no more than 200,000, you're going to narrow down that search real quick and probably identify a dozen markets that fit that. And then you can keep narrowing down based on other criteria. So that's one of the big pros, is just you can go, because when you're stuck at your home base and you think that that's all there is to invest in, that limits you in a lot of ways. You're limited by your geography and what's there. You might live in a good market, or you might live in a terrible market, or you might live in a very expensive market like we talked about last time. Mm-hmm. Or it might be so cheap that maybe you just feel like there's no room for appreciation, or maybe something about the local economy and that, jobs are kind of scarce, things like that. Mm-hmm. And personally, I don't want to drive an hour or two to manage a property or to even go look at properties. Not the worst thing in the world to do at first, because it helps get your feet wet. But I would rather identify one of those markets that is more appealing somewhere else. And actually, something we'll be talking about next time, just to tease the next video, is we're going to be talking about landlord laws and how they affect landlords and tenants, and how some states are better or worse for landlords and tenants. So that's another thing that you can be thinking of when you're examining these markets. If you could identify something, you pick a dozen markets, but then you see that, 60% of them are, tenant friendly instead of landlord friendly, you probably scratch those off your list. And then you can circle those that are more landlord friendly. Case in point, where we live, Madison, Wisconsin, not super landlord friendly. There are a lot of rules and regulations. Now, I think you're looking a little bit outside of the area, so some of those rules are going to vary from municipality to municipality. But if you're in Madison proper, it's kind of a headache to be a landlord here. But each state has their own statutes, so they do cover the entire state. So it's going to go through some of the major things like evictions and some other rules regarding tenant landlord relations. So anyway, those are a couple of the pros. Now, a couple of the cons is it can be expensive to try to identify a market. You might think that there's a market in Texas that's awesome, and you go check it out and figure out it's probably not for you, or you don't like the people you met with there or something like that, and you figure it's going to be really hard to build a team, or you find out that there's just way too much competition. Well, you just kind of wasted a plane ticket and a stay in a hotel to do that. Another con is just the inability to have hands-on property management. Obviously, you're going to have boots on the ground in a long distance kind of thing. I mean, I suppose some landlords could do it, but I don't think that many would like to. And so there's going to be a component of property management that would need to be in place and that's going to hurt your cash flow a little bit. And if you're close to home and you manage yourself, that's a nice little boost. It could be a 5 to 10% boost on your cash flow. And I would recommend to anyone starting out, you should manage your first 1 or 2 properties just so you know kind of how to do it. I mean, if you can. I mean, if you want to go straight to property management, that's fine, but you want to make sure that you know how to interview your property manager too, and make sure that they know what they're doing, because there's a lot of bad property managers out there as well. So you kind of want to have some of those things in place where you know the basics of property management, and that way when you hand it off to someone else, you can tell them exactly what to do and how to do it. And they might have some different ways of doing things, but as long as you're on the basic same page there, and they're not making your property into some sort of slumlord property, it's just important to know how things work from that angle. I'm trying to think of some other cons. I really can't think of any, but I'm sure you can. I mean, what are some fears that you would have, investing long distance?
Yeah, I think the biggest fear is you literally don't really have control. And being someone who hasn't, fully experienced real estate and its, ups and downs, it's scary to think that you're putting all your trust into someone else and a property management to handle that. I mean, obviously, like you said, you could try to do it by yourself long distance, but there's going to be issues that come up where there's a leaky faucet or something like that, and you're going to have to somehow make sure that work gets complete. Either you have to have a really good relationship with the tenant, I would say, or you need someone who's boots on the ground that you can trust, who's going to get the job done. Otherwise, yeah, like you said, you might be in a situation where you're turning more into a slumlord versus a high quality property, which I think we both would agree that it's more important to have a good property than, you know, a not so great property that nobody wants to stay at.
Yes, that's generally true. Yeah, and the nicer the property too, even if there's a bunch of like properties, if you take care of yours a little bit better,
Mhm.
and maybe have a few nicer touches here and there, you can get more rent. The
Mhm.
nice thing about rent rates is, yeah, there's going to be like a market rent for say
Mhm.
a 2-bedroom, 1 bath. Let's
Mhm.
just call it $800, but there's no rule that says you can't charge 850 because you have granite countertops in yours, or you have a bigger backyard,
Mhm.
or it's freshly painted, or whatever it is. I mean, tenants want certain things, and if they go visit 3 2-bed 1 baths and this one has old nasty Formica countertops but yours has nice new granite countertops, and it's only $50 a month more, I mean,
They'll probably take it.
they'll probably take it. I mean, the same thing kind of with when you're looking at houses. I mean, if you have 2 houses and they're both houses that are the same size, roughly the same price range, all that kind of
Mhm.
stuff, but one has slightly better finishes, it just shows better, and buyers are going to go after the nicer one. But with rents, you don't have to, you're not beholden to like comps per se. You can kind
Mhm.
of set your rate if someone pays it, as long as you're not like price gouging. I mean, if someone pays it, that's great.
Mhm.
So,
Yeah.
the one thing I was going to say, you know, when it does come to any type of investing, it's always going to take a team.
Mhm.
So, if you're even if you're investing a mile away, you need a team. So whether it's
Mhm.
a mile or 1,000, you need a team. You're going to need, you know, realtor, property manager, construction, maintenance, title company, attorney, um, and about, you know, 50 other things. You know, just a list of vendors, or sometimes your realtor or property manager will have like a list of vendors of go-to people. Like maybe you don't know
Mhm.
who the right plumber is to call, and so you're just kind of looking online, and hopefully they work out, but hopefully they have some trusted vendors in place. And that's the nice thing when you do find a good property manager or realtor, um, that they can just be that extension to these people that they already have relationships with, and that already are vetted essentially. And that's what
Mhm.
gives me a lot of peace of mind with the properties we own, because most of those are under property management, and I don't have to worry about calling 5 contractors to get a bid on drywall fixes.
Mhm.
You know, that falls on the property manager. You know, if it's a little thing like just a toilet leak, you know, probably don't even hear about it. You see it on your monthly statement that there
Mhm.
was a leak. It cost $70 to fix, you know, something like that. Whereas when you're managing yourself, you're getting the phone call or the email,
Mhm.
and then you got to figure it out. Okay, who's my go-to person here? And it might be something, you know, plumbers you can find, electricians you can find, but what if it's something really niche, like some sort of I don't know, something like a very specific roof problem. You know,
Mhm.
like I had a property once that I was flipping that had a flat roof, and it was so hard to find a good roofer that knew flat roofs because it just wasn't common in that area. It was mostly pitched roofs. So
Mhm.
stuff like that you just don't know that could come up. It's nice to have people who have direct contact with other vendors.
Mhm.
Um, so yeah, it's all about a team, and you know, we still manage, I guess, just one property. One of our 28 units. I guess I manage it for the most part. It was actually the first property we ever bought, and the same tenants are still there, and they're awesome tenants, and they always tell us if something's wrong, and then we take care of it right away. And they've just been very easy to deal with. So ideally, you know, for your first property or all your properties, you'll get tenants like that are long-term tenants that want to be there, and that communicate well and let you know when there's a problem, because that's what you want. You don't want people to put up with a problem and
Yeah.
then it becomes a bigger problem for you later on, especially if you're, you know, doing some sort of turnover to the next tenant and you're like, why did they never tell me there was a leaky toilet and now we have this huge mess in the basement? You know, it's something that they lived with, maybe they didn't even notice it, but
Yeah.
some people just, they don't really care. It's not their house. And that's why it's very important to train your tenants. And this is one thing, one of my most, and not to give a shout out to myself, but I will, one of my most popular videos on YouTube is about finding good tenants. And so I go in depth of like how to do that and tools to use and things to do. And so one of the things what I talk about is basically training your tenants, because what most people do is they find the tenant and then they sign the lease and they're like, here are the keys. Send me the rent checks every month. That's usually the basics. But in a lease agreement, I mean, it's usually pages long. Even if it's just 2 pages, there's a lot to cover there. Like what happens if there is a fix needed? Like, are they supposed to call you? Are they supposed to call a plumber right away? Like, what's the chain of command? What did they need to communicate with you on? All sorts of things. So it's really important to go through the lease item by item, take some time. It's going to take a little time to just explain everything to them, but then everything's out on the table and they know what to expect. Setting the expectations are just really, really important at the beginning of that landlord-tenant relationships. It's one thing to find a great tenant, at least they look good on paper, but then if they kind of don't know what your expectations are, you're going to suffer more disappointment than they are. So you're only hurting yourself if you're not explaining all those terms.
Yeah, I agree. And I think the second question I had going off of your question, the downsides to investing out of state would be the laws in different states, which is good that that's our next, topic, a little teaser again, is to kind of nail down what to look for. How do you know it's a landlord friendly state? How do you know it's a tenant friendly area, or just looking in the municipality? So I think that would be a big boost to confidence and trust in a different market, is just knowing those facts.
Right. Yeah, that is it's a big question mark for a lot of people. And it's something I think a lot of new investors don't really think about. They don't think about, is my area a good spot for me as a landlord, or is it better for the tenants? A lot of times they're just like, well, I just want the best deal. But that's not everything when it comes to real estate. You want the thing about real estate that we like as investors is the amount of control that we possess over it. We don't have control over a stock in the stock market, unless you're the CEO of that company and you can somehow, help move the needle. I mean, we have control over where we buy, how we add value to it, the tenant we put in there, and then how we manage the property. So we have all these controls. The things that are outside of our control, besides the obvious things like weather, natural disasters, things like that, are the landlord tenant laws for the state. And then each municipality can have their little adjustments too. So really important wherever you invest that you go and read that boring section of the website on all their, all the landlord and tenant rights. But yeah, we'll get into that.
Great.
So did you have any other, hot takes on long distance investing? We've talked a lot about this, and I'm pretty sure you're going to stick fairly close to home for your first one. But does it appeal to you in the future, maybe?
Yes, it definitely does. I think even just talking right now is making me second guess or rethink about the one we talked about to start with the question I had, just because I know that it might not be the most landlord friendly area, just based on previous discussions and experience. So it's making me question it already, to maybe I need to look, maybe that needs to be the starting point, is go there and then you can go find the deal, which is kind of what a big takeaway here for me is you need to find that first.
So maybe you don't need a gift after all.
Don't need a gift.
No seasoning. Cool. Well, yeah. Well, I think that our next conversation will be super fun and interesting then. And you guys can check that out next week. So stay tuned and we'll see you guys next time.